FTX did not collapse because cryptocurrency prices fell. It collapsed because controls did not exist. Customer deposits were commingled. Related entities borrowed freely. Risk management was informal. Balance sheet transparency was limited. Valuation was based on internal tokens. Confidence substituted for compliance. When questions emerged about liquidity, withdrawals accelerated. Assets were not where customers assumed they were. Within days, billions in deposits were frozen. On November 11, 2022, FTX filed for bankruptcy. The failure was not market volatility, it was governance absence inside a leveraged financial structure.
FTX was founded in 2019 as a cryptocurrency derivatives exchange. Its model was built around matching buyers and sellers of digital assets. Exchanges function as intermediaries rather than principal investors. Customer assets are expected to remain segregated. Revenue is typically generated through trading fees. Liquidity is central to exchange credibility. In early years, FTX positioned itself as technologically advanced. It offered perpetual futures and leveraged products. Institutional investors were targeted alongside retail participants. The platform emphasized execution speed and capital efficiency. Custody of digital assets was handled internally. User balances were reflected on centralized dashboards. Internal ledgers tracked asset ownership. External audit transparency was limited. Governance structures were lean relative to scale. The exchange expanded internationally. Regulatory frameworks differed across jurisdictions. FTX.com operated offshore. A separate U.S. entity was structured for domestic users. Rapid product expansion increased operational complexity. Margin trading became a significant revenue source. Collateral management required constant monitoring. Risk engines were designed internally. Public disclosures emphasized innovation and growth. Customer deposits increased rapidly during market expansion. The exchange reported strong trading volumes. Brand visibility rose through sponsorships and marketing. Valuation metrics accelerated quickly. Liquidity appeared deep during peak trading periods. User confidence was reinforced by continuous platform uptime. Balance sheet visibility remained limited to insiders. Digital asset markets remained volatile. Exchanges rely heavily on trust in custodial practices. Segregation of funds is foundational to stability. Internal accounting systems must reconcile continuously. Rapid growth tested internal infrastructure. Executive oversight concentrated within a small leadership group. Formal risk committees were limited in structure. Operational documentation was not fully institutionalized. As scale increased, structural discipline lagged. External investors focused on revenue expansion. The exchange model depends on liquidity confidence. When liquidity perception weakens, withdrawals accelerate. Structural takeaway. An exchange's stability depends not on volume alone, but on disciplined custody, governance, and continuous reconciliation. 2020 and 2022, FTX experienced rapid valuation growth. Private funding rounds increased enterprise value into the tens of billions. Investors cited trading volume expansion as primary justification. Revenue growth outpaced many traditional exchanges. Market enthusiasm for digital assets amplified demand. FTX positioned itself as institutional-grade infrastructure. Capital was raised from venture firms and strategic investors. Equity rounds were completed at escalating price levels. Reported valuations reflected optimistic growth assumptions. Liquidity conditions in crypto markets remained favorable. User acquisition accelerated during price rallies. Derivatives trading volumes expanded significantly. Margin products generated higher fee yield. Token listings attracted additional retail flow. Brand partnerships increased public visibility. Marketing spend expanded proportionally with revenue. Sponsorship agreements reinforced global presence. The exchange was presented as financially strong. Balance sheet transparency to outside observers remained limited. Financial statements were not publicly filed in detail. Valuation relied partly on projected revenue multiples. Internal controls were not extensively documented. Governance structures did not expand proportionally with scale. Board composition remained narrow. Risk reporting processes were informal. Customer deposits grew alongside trading activity. Leverage usage increased in derivatives markets. Liquidity appeared abundant during bull conditions. Internal treasury management became more complex. Related entities operated within overlapping ownership structures. Asset custody remained centralized. Capital inflows reinforced confidence. External investors focused on market share metrics. Operational scaling outpaced institutionalization. Public perception equated growth with resilience. Liquidity assumptions were not stress-tested publicly. Valuation became narrative-driven. Market capitalization implied structural robustness. However, resilience depends on internal controls. Structural takeaway. Rapid valuation growth without proportional governance expands fragility beneath perceived strength.
FTX maintained a close relationship with Alameda Research. Alameda was a quantitative trading firm founded earlier. Ownership structures overlapped significantly. Leadership roles intersected across both entities. Alameda acted as a major market participant on FTX. The exchange benefited from Alameda's liquidity provision. Alameda benefited from preferential access. Internal credit arrangements were not publicly detailed. Customer deposits were reportedly accessible to Alameda. This created related party exposure. Segregation between exchange and trading firm was limited. Risk transfer occurred within a concentrated ownership structure. Governance oversight did not fully separate interests. Independent board supervision was minimal. Margin requirements were reportedly flexible for Alameda. Collateral thresholds differed from standard participants. Internal accounting entries reflected intra-company balances. External users were not fully informed of exposure levels. Balance sheet transparency remained restricted. The relationship increased counterparty concentration risk. Alameda carried leveraged trading positions. Volatility in digital asset prices impacted collateral valuation. Token-based collateral included internally issued assets. Liquidity assumptions depended on continuous market depth. Internal risk reporting was not publicly audited. Asset transfers between entities were recorded internally. Operational controls were informal. Decision authority concentrated among a small executive group. Conflict of interest management frameworks were limited. External investors focused on consolidated valuation. Disclosure documents did not fully map related party flows. Liquidity buffers were shared implicitly. Leverage amplification increased systemic sensitivity. As long as asset prices rose, exposure remained masked. When prices declined, collateral quality weakened. Related party borrowing reduced immediate liquidity pressure. However, it increased structural fragility. The exchange and trading firm operated within overlapping risk boundaries. External counterparties assumed separation. Structural separation did not match economic reality. Risk concentration accumulated quietly. Structural takeaway. Related party structures without independent controls transform liquidity into internally recycled leverage.
FTX issued its own exchange token, FTT. The token provided trading discounts and platform incentives. It was also held on the balance sheet. Market capitalization of FTT increased during expansion. Internal valuation incorporated token market price. Alameda reportedly held significant quantities of FTT. FTT was used as collateral for borrowing. Collateral quality depended on active market demand. Liquidity depth for the token was limited relative to supply. Large sell pressure would impact price materially. Internal collateral assumptions treated token value as stable. Balance sheet strength reflected token valuation. External observers could not verify full liquidity profile. Token-based collateral created reflexive exposure. If confidence declined, token price would fall. Falling price reduced collateral coverage. Reduced coverage required additional support. Support often required further token issuance or transfers. This increased supply concentration. Valuation stability depended on restricted circulation. Market perception equated token price with platform health. Public trading volumes reinforced price narrative. Internal accounting did not fully discount liquidity risk. Collateral haircuts were reportedly minimal. Risk management documentation was not comprehensive. Token exposure linked exchange stability to its own equity proxy. Diversified asset backing was limited. Price discovery was sensitive to market sentiment. Balance sheet leverage incorporated internally valued assets. Confidence sustained the structure. Token liquidity was not stress-tested publicly. Institutional investors relied on headline valuation metrics. Internal treasury management referenced token value. As long as token price remained elevated, solvency appeared intact. Once selling pressure increased, valuation compressed. Collateral shortfalls emerged quickly. Liquidity buffers eroded in parallel. The structure required continuous confidence in token demand. Token value functioned as structural support. When token credibility weakened, balance sheet resilience declined. Structural takeaway: when internally issued tokens underpin collateral, valuation reflexivity converts confidence loss into immediate balance sheet compression.
Governance architecture at FTX remained highly concentrated. Key decision authority resided within a small executive circle. Formal board structure was limited in scope. Independent directors were minimal relative to scale. Internal audit functions were underdeveloped. Financial reporting processes were informal. Entity structures spanned multiple jurisdictions. Documentation consistency varied across subsidiaries. Role definitions overlapped between affiliated entities. Related party transaction oversight lacked formal separation. Risk committees were not fully institutionalized. Treasury controls were not standardized. Access permissions to internal systems were broad. Code-base management did not follow conventional enterprise controls. Record-keeping practices were inconsistent. Regulatory compliance resources were unevenly distributed. Internal policy documentation was limited. Capital allocation decisions were centralized. Large transactions did not always undergo layered review. Operational transparency to external stakeholders was restricted. External auditors did not oversee all entities uniformly. Consolidated reporting was not publicly comprehensive. Rapid expansion outpaced structural formalization. Governance scaling lagged revenue scaling. Internal escalation channels were unclear. Conflict management frameworks were underdeveloped. Decision documentation trails were incomplete. Segregation of duties was not rigorously enforced. Custodial oversight mechanisms were informal.
Board-level risk reporting was limited in depth. Internal liquidity reporting lacked standardized cadence. Enterprise risk management frameworks were not mature. Organizational design reflected startup orientation. However, scale had become institutional in magnitude. Customer assets were held within complex entity structures. Control infrastructure did not expand proportionally. Operational reliance on executive trust remained high. Formal governance mechanisms did not match asset scale. Structural vulnerability increased with growth. Structural takeaway. Governance infrastructure must scale with assets. When it does not, operational complexity converts into systemic exposure.
Risk management systems at FTX were internally designed. Margin requirements were adjusted algorithmically. However, override authority existed. Certain counterparties received preferential treatment. Liquidation engines were not uniformly enforced. Exposure limits were flexible in practice. Internal dashboards reflected aggregate positions. Stress testing frameworks were limited in scope. Scenario analysis was not fully institutionalized. Collateral valuation referenced market price feeds. Price feeds were subject to volatility. Liquidity depth assumptions were not conservatively modeled. Cross-entity exposure was not ring-fenced. Risk concentration accumulated across affiliated structures. Independent risk oversight was minimal. Credit evaluation processes were informal. Large borrowing positions were reportedly extended. Internal lending terms lacked external disclosure. Collateral quality was not independently verified. Token-based assets comprised significant support. Volatility sensitivity was high. Liquidity buffers were not publicly stress-tested. Withdrawal scenarios were not transparently modeled. Internal reconciliation processes were not externally audited. Operational reporting cadence varied. Risk escalation channels were unclear. Enterprise-wide exposure aggregation was limited. Balance sheet leverage expanded quietly. Counterparty concentration risk increased. Liquidity confidence substituted for capital discipline. Internal control documentation was sparse. Governance committees lacked structured independence. Operational resilience relied on continued inflows. When inflows slowed, flexibility narrowed. Risk tolerance exceeded formal policy articulation. Valuation optimism influenced collateral acceptance. Internal leverage amplified market volatility. Control infrastructure did not constrain expansion. Structural takeaway. Without independent and enforceable risk controls, leverage accumulates faster than oversight capacity.
In early November 2022, liquidity questions began circulating publicly. Reports referenced concentration of assets in FTT. Balance sheet excerpts from affiliated entities were shared externally. Market participants began evaluating collateral composition. Confidence in token-backed assets weakened. Price of FTT declined sharply. Collateral coverage ratios deteriorated. Margin positions required additional support. Alameda's leverage became central to discussion. Counterparties reassessed credit exposure. Exchange users monitored social media disclosures. Withdrawal requests began increasing. On-chain transfer activity accelerated. Liquidity assumptions were tested in real time. Internal reserves were not fully segregated. Customer deposit backing became uncertain. Treasury teams attempted to stabilize balances. Public statements emphasized solvency. However, disclosure detail remained limited. Large withdrawal requests strained available liquidity. Trading activity continued during initial outflows. Asset sales were explored. Market depth proved thinner than assumed. Token price decline intensified collateral pressure. Confidence erosion accelerated withdrawal velocity. Liquidity buffers contracted rapidly. Internal transfers attempted to meet demand. Stablecoin balances declined. Exchange hot wallets showed reduced reserves. Users experienced delayed processing times. Institutional counterparties reduced exposure. Potential acquisition discussions surfaced. Market volatility amplified uncertainty. Creditors sought clarity. Within days, liquidity became critically constrained. Public confidence reversed abruptly. Structural separation between entities blurred. Structural takeaway. When transparency gaps intersect with collateral reflexivity, liquidity stress compounds at digital speed. Withdrawal speed compresses liquidity timelines, leaving no margin for control failure. Billions in customer requests were submitted. Exchange reserves declined rapidly. On-chain balances were monitored publicly. Liquidity inflows did not match outflows. Collateral liquidation proved insufficient. Asset valuations compressed under selling pressure. Internal treasury transfers attempted to cover gaps. Intercompany balances were reallocated. Withdrawal limits were introduced. Processing delays became visible to users. Public confidence deteriorated further. Potential capital injection discussions were reported. Due diligence exposed balance sheet deficiencies. Short-term funding options narrowed. Token price declines accelerated across affiliated entities. Internal liquidity buffers approached depletion. Customer asset availability became uncertain. Operational decision-making accelerated. Regulatory inquiries increased. Advisors were engaged. Chapter 11 preparation discussions began. User access to withdrawals was paused. Market participants reassessed FTX exposure. Crypto markets reacted with volatility. Credit relationships were suspended. External counterparties froze activity. Balance sheet solvency was questioned openly. Internal communication frequency increased. Governance gaps became visible. Confidence-based liquidity evaporated. Digital asset custodial assumptions were invalidated. Structural interdependencies surfaced publicly. Within days, operational continuity ceased. On November 11, 2022, FTX filed for Chapter 11 bankruptcy protection. Structural takeaway. In digitally networked finance, withdrawal speed compresses liquidity timelines, leaving no margin for control failure. The Chapter 11 filing revealed fragmented financial records. New management described the situation as unprecedented control failure. Cash balances were lower than previously assumed. Intercompany loans lacked formal documentation. Customer asset segregation was incomplete. Digital wallets were not fully reconciled. Liabilities exceeded readily available liquid assets. Accounting systems varied across entities. Board oversight documentation was sparse. Internal approval processes were inconsistent. Related party exposures required reconstruction. Asset recovery became complex. Regulatory authorities initiated formal investigations. Creditors assembled to evaluate claims. Customer deposit shortfalls were quantified. Bankruptcy court filings detailed structural deficiencies. Governance weaknesses became central narrative. Risk management documentation was limited. Internal communication logs were reviewed. Transaction trails required forensic analysis. External auditors were not uniformly engaged. Capital structure proved opaque. Enterprise valuation required re-estimation. Token holdings lost material value. Liquidity shortfall extended across subsidiaries. Operational continuity required court supervision. Employees faced organizational uncertainty. Customer claims processing began. Asset sale exploration was initiated. Exchange brand value deteriorated. Industry participants reassessed custodial risk. Investor confidence in centralized exchanges declined. Regulatory scrutiny of crypto platforms intensified. Control infrastructure deficiencies became public record. The collapse redefined risk perception in digital asset markets. Structural takeaway. Bankruptcy converted informal operational practices into documented systemic exposure.
The collapse extended beyond a single exchange. Market participants reassessed counterparty exposure. Crypto lending platforms faced liquidity strain. Token prices across the sector declined. Stablecoin redemptions increased temporarily. Centralized exchanges published proof of reserve statements. Investors demanded greater transparency. Venture capital valuations were revised downward. Credit relationships within the ecosystem tightened. Risk premiums expanded. Custodial segregation practices were scrutinized. Governance frameworks became investor focus. Regulators accelerated policy discussions. Legislative proposals addressed exchange oversight. Institutional allocators paused new exposure. Liquidity across digital asset markets contracted. Interconnected leverage unwound. Margin calls propagated across trading firms. Collateral requirements increased broadly. Funding costs rose. Asset volatility intensified. Market depth thinned. Confidence in centralized custody weakened. Self-custody solutions gained visibility. Auditing standards for digital assets were debated. Disclosure expectations expanded. Board composition requirements were discussed. Enterprise risk management models were updated. Industry consolidation accelerated. Surviving exchanges emphasized governance reform. Structural fragility became clearer in retrospect. Scale without controls was recognized as hazard. The ecosystem adjusted toward greater oversight. Structural takeaway. Contagion reveals how interconnected leverage transmits governance failure across market participants.
FTX collapse underscored governance as financial infrastructure. Scale does not substitute for control systems. Liquidity confidence cannot replace reconciliation discipline. Related party exposure requires independent oversight. Segregation of customer assets is foundational. Risk management must be enforceable, not discretionary. Board independence must expand with valuation. Rapid growth amplifies small structural weaknesses. Token-based collateral embeds reflexive instability. Transparency reduces withdrawal velocity during stress. Internal controls must precede capital inflows. Documentation is not optional at institutional scale. Enterprise risk aggregation must be centralized. Stress testing must assume confidence shock. Liquidity planning must incorporate rapid digital withdrawal speed. Collateral valuation must reflect true market depth. Intercompany lending requires strict separation. Audit scope must match organizational complexity. Regulatory arbitrage introduces governance blind spots. Capital structure resilience depends on clarity. Operational trust must be supported by systems. Executive concentration increases fragility. Disclosure quality influences funding stability. Leverage without oversight compounds volatility. Growth narratives cannot replace internal discipline. Investor diligence must extend beyond valuation metrics. Confidence-based liquidity is inherently unstable. Digital finance accelerates failure timelines. Governance architecture determines survival probability. When governance scales with assets, resilience improves. When governance lags scale, fragility compounds. FTX demonstrated the cost of institutional underdevelopment. The collapse was structural, not technological. Governance is infrastructure. When it is absent, scale accelerates collapse. Corporate collapse is structure meeting stress. Structural takeaway. Governance is infrastructure. When it is absent, scale accelerates collapse. Corporate collapse is structure meeting stress.